Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. If you're just opening your trading terminal or maybe just grabbing your first coffee this January 12th, 2026, you might want to make it a triple espresso.
You're not kidding.
We are facing a truly unprecedented convergence of shocks this morning. There's this political clash threatening the independence of the Federal Reserve.
A huge one.
Then you have escalating geopolitical tensions, shaking up energy markets, and on top of all that, some really crucial, immediate changes to your personal retirement savings strategy.
Yeah.
So our mission really in this deep dive is to take this huge stack of reports we have, CNBC, Bloomberg, Reuters,
Yeah.
and just cut right to the core of what you need to understand.
It really is, as some analysts are calling it, a truly kinetic start to the week. When you look at the overnight reports, three stories just jump out. They're overshadowing almost everything else.
Okay, what are they?
First, the incredible news of a criminal probe targeting the Fed chair. Second, the rising risk premium around Iran, specifically what that means for global oil choke points. And third, the ongoing fallout from the intervention in Venezuela, which is, actively pitting political interests against corporate autonomy.
Okay, let's unpack that domestic shock first, because this feels like where all the uncertainty really kicks off. Fed Chair Jerome Powell revealed late Sunday that the Justice Department served the Fed with grand jury subpoenas.
Yeah.
And according to reports from both CNBC and Yahoo Finance, the official reason given is a threat of a criminal indictment. It's related to his testimony back in June about that controversial $2.5 billion headquarters renovation.
Right. But what's fascinating is how fast the narrative shifted, from a simple spending issue to a fundamental question of central bank independence. That's the cornerstone of the whole modern financial system.
So Powell is saying it's not about the building.
Exactly. He himself stated that the renovation is just the pretext. He says the actual reason for these threats is the Fed's refusal to just cave to political pressure for faster interest rate cuts.
Yeah.
He's basically drawing a line in the sand. He's saying this is a test.
Yeah.
Is monetary policy going to be set by economic evidence or by Washington?
And of course, the political counterpunch came instantly.
Immediately.
President Trump denies the investigation is just about rates, but he hasn't exactly distanced himself from it either. He's out there criticizing Powell's competence both on the renovation and his general performance at the Fed. And for context for you, Powell's term as chair ends in May. So if this instability keeps up, we could be looking at a new appointment very soon.
Even though his term as a governor runs until January 2028. And that May expiration date is what's really driving the market's reaction right now. Bloomberg data shows U.S. stock futures, the S&P 500, the Dow, NASDAQ 100, they all slid sharply this morning. It's all driven by this profound uncertainty over the Fed's independence. But the real tell, the really insightful move, is in the currency market.
Okay, what are we seeing there?
The Bloomberg Dollar Spot Index, it had its steepest decline in almost 3 weeks. That's essentially a signal that global investors are getting worried about holding U.S. assets.
So if the dollar is dropping, that instability must be fueling a rush into safe haven assets. This is where we see the big move.
That's it exactly.
Yep.
Gold, specifically the futures contract GCF, it surged to a new record high. According to CNBC, it's getting close to $4,600 an ounce.
Wow.
And this rally is driven by two things. First is that classic flight to safety, sure. But second, and this is maybe more important, it's the explicit prospect of the president appointing a new, more dovish Fed chair once Powell is potentially sidelined in May.
And a more dovish Fed means what for gold?
Lower interest rates down the road. A more politically compliant Fed will cut rates, and that traditionally makes gold more attractive because it lowers the opportunity cost of holding a non-yielding asset like that.
So I'm seeing analyst reports from Bloomberg now using this phrase, a sell America trade. Can you just clarify for the listener what that means in this context?
Sure. It just means that international investors perceive a higher political risk premium on holding U.S. assets. We're talking stocks, bonds, even the dollar itself. It's because the stability of our institutions, specifically the Fed, is now openly under attack. So they're selling or at least shortening their exposure to U.S. assets and buying into alternatives.
Like gold or maybe stable European bonds.
Exactly, until this political cloud clears up. I mean, this is less about economics and more about the fundamental integrity of U.S. financial governance. The market is betting this won't be resolved quickly.
And that domestic political risk spills right over into global geopolitics. Let's pivot to the Middle East, specifically Iran. Reports from CNBC and Reuters say the U.S. is weighing some major options, everything from cyber and economic measures to potential military responses against Iran.
Yeah, and this is happening as these anti-government protests over crippling domestic inflation are still going on. A U.S.-based rights group said that more than 500 people have died.
The energy market exposure here feels massive.
It is. It's why this story demands our attention. Look, unlike the situation in Venezuela, Iran is far more capable of directly disrupting global supply. Their key retaliatory tool is the Strait of Hormuz.
The strait is always called the world's main choke point, but for anyone who might not be visualizing the geography, why exactly can Iran threaten it so effectively?
Well, if you just look at a map, the Strait of Hormuz is this very narrow passage. It's only about 21 miles wide at its narrowest point. And crucially, the northern border of that strait is defined entirely by Iran's coastline. So they have the physical means to disrupt or even close shipping lanes if they really choose to escalate.
And what kind of volume are we talking about?
Data that CNBC cited confirms the strait accounts for roughly 31% of all global seaborne crude flows.
31%, that is a colossal number. What's the market's assessment of that risk right now?
Well, analysts caution that a full closure is a low probability event, mainly because of the overwhelming U.S. naval presence there. But even the threat is incredibly potent. They estimate a closure could spike oil prices by $10 to $20 a barrel, almost instantly.
But oil isn't spiking this morning.
No. Reuters is reporting that Brent crude actually dipped a little this morning to $63.25. This suggests the market is, for now, viewing the risk as contained. It's waiting for actual concrete evidence of a disruption to supply before it prices in that full, catastrophic scenario. It's the definition of a slow burn risk.
That idea of political maneuvering dictating energy investment, it brings us right to the continued fallout from the U.S. intervention in Venezuela. We saw a really interesting and, frankly, kind of bizarre clash reported over the weekend between the administration and ExxonMobil.
Yeah, there was a clear demonstration of unilateral executive power being just, applied to corporate decision-making.
The president has been pushing hard for $100 billion in investment into Venezuela's energy sector.
Backed by U.S. security guarantees.
Right. But according to CNBC, Exxon CEO Darren Woods openly called the market uninvestable in its current state. He cited the need for massive legal and commercial framework changes first.
So a major American corporation makes a decision based on risk assessment, and the president's reaction was, he essentially threatened to sideline Exxon from re-entering the country at all. He said he didn't appreciate their response and accused them of playing too cute.
Playing too cute.
I mean, it's critical because it just mirrors the Fed story. You have Washington attempting to direct these highly specialized economic and corporate decisions based on political goals, whether that's monetary policy or multi-billion-dollar oil investments.
Okay, setting aside the cuteness factor, did the intervention actually achieve its regional goal for other big operators like Chevron and Exxon who are nearby?
It seems like it did. And this is the specific nugget for the energy sector. Analysts speaking to CNBC noted that the U.S. military presence appears to have put Venezuela's long-standing claims over Guyana's oil-rich Essequibo region on ice.
So that threat is gone for now.
For now. Caracas is dealing with its own issues, and with intense pressure from the U.S., it's extremely unlikely to pursue that claim. So for operators with expensive facilities in Guyana, this removes a significant, if temporary, nuisance.
It's just striking how willing the administration is to intervene in, well, everything. That thought transitions us perfectly to domestic consumer finance. Bloomberg and Yahoo Finance are reporting the president has now demanded that credit card lenders cap interest rates at a maximum of 10% for 1 year. And he set a hard deadline of January 20th.
This is a massive market intervention. I mean, with some current rates up near 30%, a 10% cap would fundamentally reshape consumer lending in the U.S.
Yeah.
And critically, the president claimed that not complying would be a violation of the law, but he didn't cite any specific legal statute to back that up.
So another mandate without a clear legal foundation, kind of like the pressure on the Fed. How did the market and the industry react?
Well, credit card company stocks like Capital One and American Express, they fell sharply in pre-market trading. But the drop wasn't catastrophic. Capital One was only down about 3%.
Which suggests what?
It suggests the market is deeply skeptical that this unilateral 10% cap will actually survive any legal challenges or fully materialize. But the banking trade groups, they were quick to issue some pretty grave warnings.
Saying what?
saying that a rigid cap like this would lead to a severe reduction in credit availability, especially for millions of American families and small business owners who are deemed higher risk, the very people who depend on those higher interest credit options.
That's a huge issue for the short term, but let's shift to something immediately actionable for our listener. The 2026 retirement contribution updates that CNBC detailed. As we start the year, what are the key numbers we need to know?
Absolutely. If you're aiming to max out your tax-advantaged accounts, these numbers are crucial. For 2026, the individual contribution limit for your 401k is rising to $24,500. That's up $1,000 from 2025. But what many people overlook is the total plan limit.
Right, that includes your contribution, the employer match, any profit sharing.
Exactly. And that full plan limit is now capped at $72,000.
And what about for those age 50 and older? The catch-up limits are always a critical tool.
We got a nice bump. Investors 50 and over get a higher general catch-up cap of $8,000, up from $7,500. And then there's that very specific super catch-up for savers between 60 and 63, which is holding steady at $11,250.
And for IRAs?
The limit rose to $7,500, and the catch-up for 50-plus is now $1,100.
Okay, beyond the higher numbers, what's the biggest functional change that high earners listening right now really need to be aware of? This is the core deep dive nugget here.
It's the Secure 2.0 Act provision that's kicking in this year, and it's a big deal for high earners. Starting in 2026, if you earned over $150,000 from the same employer in 2025, you are now legally mandated to make your catch-up contributions on a Roth basis.
Meaning after-tax contributions. Why is that such a significant change?
Because it fundamentally changes the tax advantage. Previously, high earners loved the traditional catch-up because it was pre-tax, right? It immediately reduced their taxable income. Now, those contributions are mandatory after tax. The tax break happens when you pull the money out in retirement, not now.
So you need to plan for that now.
Immediately. It's pushing advisors to tell clients to review their contribution strategy right away, especially since only about 14% of participants even maxed out their 401ks in 2024. If you hit that income threshold, you need to revisit your payroll deductions today.
That transition from domestic finance to these big global structural issues takes us neatly into our final topic. China's challenging economic paradox. CNBC and the Rhodium Group have reports detailing this fundamental misalignment where China's massive push into future industries, AI, robotics, EVs, is just not big enough or fast enough to make up for the deep slump in its traditional sectors.
This is the long-term story that should concern every global investor. I mean, China's trying to pivot its entire economy, but the old machine is collapsing faster than the new machine can be built. The Rhodium Group report had some really stark statistics. The property sector, it used to be over a quarter of the entire Chinese economy. Massive employment, wealth storage, all of it.
And what's the tangible damage from that decline?
Well, from 2023 through 2025, these new high-tech industries only added about 0.8 percentage points to economic output. That is just utterly dwarfed by the drag from real estate and traditional sectors, which was a combined 6 percentage point hit.
A 6-point drag.
Yeah. New home sales last year fell to levels we haven't seen since the 2009 financial crisis. That's an enormous hole to climb out of, especially when Beijing is targeting, roughly 5% GDP growth.
It seems mathematically impossible to hit that target under these conditions.
It is deeply, deeply challenging. Rhodium Group estimates that for China to sustain that 5% target, the new industries would need to expand sevenfold over the next 5 years. That would require an additional 2.8 trillion yuan in new investment just this year alone.
And that kind of growth is...
It's extremely hard to sustain across multiple emerging industries all at once.
And this structural shift also creates a profound social problem, right? The issue of employment. These new industries are capital-intensive, not labor-intensive.
Precisely. The Rhodium analysis highlighted that. These new sectors just employ far fewer people than mass-market manufacturing and property did. And when you factor in automation, which is accelerating, some estimates suggest China could lose up to 100 million jobs over the next decade.
100 million jobs.
Which risks making youth unemployment, already 3 times the urban average, even worse. The government is basically choosing technological self-reliance over mass employment.
So if domestic consumption is stalled and internal investment can't keep up, China becomes more and more dependent on exporting its way out of the problem.
That is the direct implication. The domestic imbalance forces China to gain market share in foreign markets by driving exports. The Rhodium Group noted this makes the entire country more exposed to trade risks.
Like the tariffs we're seeing from the US, Mexico, and the EU?
Exactly. China is effectively exporting its domestic excess capacity, and that, in turn, draws immediate fire from its trading partners.
What an absolute pileup of news to start the week. So to quickly summarize for you, the learner, we saw three massive forces collide this morning. First, the unprecedented political risk to the Fed's independence, which is driving safe haven demand into gold. Second, the geopolitical tensions driving energy market volatility. And third, those crucial personal finance updates, especially the retirement limits and that Roth catch-up mandate you need to act on now.
And if we connect all these threads, the political pressure on the Fed, the soft jobs report from last Friday, the betting in the bond market, it all raises the single most important question for the next 48 hours. You're hearing about a steepening yield curve. That just means the bond market is betting that short-term Treasury yields are rising faster than long-term ones.
A sign they see an end to the current rate policy.
It's a sign they think the central bank will be forced to cut rates sooner than expected. The bond market is essentially betting that the Fed is no longer fully independent.
And the test of that bet is tomorrow.
Exactly. How will the upcoming December Consumer Price Index report, which is due out on Tuesday, how will that reshape the market's expectations for rate cuts in mid-2026? That inflation data will either vindicate the Fed's patience or, strengthen the hand of those who want a new, more dovish direction.
A direction the market seems to be already pricing in.
Through gold and that yield curve, yes.
Absolutely. That CPI report is the next major flashpoint. For now, though, that is all we have time for in this deep dive, and we'll see you all tomorrow morning with new headlines from major financial magazines.